Today, we talk tax tips, we talk end of year, we give some suggestions, some advice before the ball drops. This is the 30. Let's go. Well, hi there, gang. Welcome to the 30 once again. I want to thank you for being here. Certainly appreciate you. Appreciate everything that you have been doing or have done for us in terms of our viewers, being our listeners. Thank you for another year, 2024. Can you believe we are approaching the end of 2024? Wow, I cannot believe it. Hey, today we're going to be talking tax tips. We have a specialist, but before we get into that, let me introduce my co-host of the 30, Sabrina. Welcome to the 30 again. Welcome.
Hello, thank you.
So how are you? I am doing well. How about yourself?
Oh, getting ready for Christmas and tax time.
Let's see. We have Christmas, we have tax time, we have end of the year.
Right. All of those rolled into one.
A lot going on.
And a lot of cooking.
Well, not me. Maybe a lot of eating, but not a lot of cooking.
Okay.
So today we have a special episode. This is called Tax Tips You Need Before the Ball Drops. And do us a huge favor. If you are viewing this and you see that there's value to it, make sure that you share and like this episode. If you're watching us from YouTube, subscribe to our channel. It's at the 30 with Patrick. Make sure that you do that. Subscribe to our YouTube channel. If you're watching us from LinkedIn, make sure that you repost. But we want you to like this episode because it's going to be full of information. So Sabrina, as we said, we have the end of the year tax tips. Where are you in terms of taxes, tips? Do you think we need more information? Do you think our viewers need some more information?
Oh, yes, they need a checklist. Do this by December 31st.
Okay, so there are some things that we need to do before December 31st.
I think we'll let the expert tell us.
Yeah. So let's not delay. You have seen him before. He came on previously, was talking about BOI. So let's welcome back Dave Young of Dave. And is it Dave Young and Company?
Young and Company CPAs. It's okay. All
Young and Company CPAs. Dave, welcome to the 30 once again.
Oh, it's great to be here. Time is running out.
Yes.
Tick, tick, tick. Time to get stuff done.
So we're going to be talking about tax tips you need before the ball drops. Go. What do we need to do?
A lot of stuff to think about. So focus on, like Sabrina said, having a nice checklist. So first of all, it helps to have a really good set of books in order. So hopefully at this point, you actually have a good accounting system that can give you a really good idea of where you stand income and expense wise, because without that, you're like driving a car blindfolded. So I'm going to assume right now you actually have a really good, clean set of books. If you don't, check. That's number one. Get that going and get that going now, because nobody can actually tell you what to do without knowing where you are.
So I'm going to
Number
stop you there.
two,
What is considered a clean books? What does that
So,
mean?
what that means is you want to have some sort of accounting system. Most people use QuickBooks, but there are other types of softwares that will basically tell you how much income you brought in, how much money are owed, accounts receivable, who owes you what, and who you owe, accounts payable. And at the end, all your income and expenses that you're reconciling your accounts. So every month you get your bank statement from the prior period and you go and reconcile, hey, this check cleared, this one didn't clear. Same thing with credit cards, same thing for loans. All of that is a big deal, and it should be done every month, like almost every week. But the reconciliation process to make sure what you have in your checkbook matches what you have in your accounting software, whatever that software is. You want to make sure that's done. And so what I mean by a good, clean set of books is books that if you're going over it with your tax professional, that he or she can look at that and make some good assumptions. But even better, you as your business owner, you have a fiduciary responsibility to yourself, your vendors, your customers, your employees to really take this business to the level of what's going on, just baseline money coming in and money going out. You had to look at your books and say, hey, this is my gross income, my total income, these are my expenses, and this is my net income. Without that, you have a real hard time figuring out any tax tips, let alone key performance indicators. It's a different whole. We could talk another 30 minutes just on that one topic. But right now, buy a clean set of books is something you can open up your computer, go into your accounting software and say, hey, my gross is this, my net is this, and this is where I stand right now here today.
Awesome. Sabrina, do you have any questions for Dave?
In terms of that particular issue, no, I think it does help to actually have somebody that knows what they're doing.
Yes.
To actually do your books.
Yes. It is vital to have a good bookkeeper work with you, which, may or may not be your CPA. Most CPAs have, a lot of CPAs have bookkeepers that work directly with their clients. But to Sabrina's point, you need to have a good bookkeeper or be a good bookkeeper yourself if you're on your own set of books.
Right.
Well, let's assume you got a good set of books. Then the next thing you want to start thinking about is, are you cash basis or accrual? And most small businesses are cash basis, which is simply meaning the only thing that counts as far as the IRS is concerned is money you actually collected and money that you actually spent, as opposed to accrual, which will take into consideration your accounts receivable as income and your accounts payable as expense. So most small businesses are typically going to be cash basis. So if you know your cash basis, which I would assume many people are, then you want to start maximizing your deductions. And that means, like, hey, if you need a new computer, you need a new thing, and you're going to spend the money in January and you're going to get it, you might as well purchase it now in 2024, right, in this current year. It has to be placed in service. So it's not good enough that you go on to Amazon and you order it, it's in transit. No, that's not good enough. It actually has to be placed in service. So when I say placed in service, that means you actually have to have physical control of it. It's actually working. It's doing its intended purpose, whether it's a computer, a machine, a vehicle, whatever that is. It needs to be placed in service, meaning it's actually in your business doing whatever it's supposed to be doing.
So I can't, let's say that I wanted to buy a new laptop or tablet. So you're saying I can't go to Amazon or to my local Best Buy or something online and order it on the 31st so that I can take advantage of the taxes for that year.
You are correct, sir. It has to be in your possession. That means it has to be actually delivered, and you actually have to turn it on and make sure it works. And so it has to be placed in service. So, keep that in mind. And when I talk about placing different assets in service, you want to make sure that you have that, that in consideration. So, just keep that in mind as far as, like, hey, I have an asset, but if it's in transit, that doesn't really count. So you want to make sure you have it, it's actually in service. So the IRS will look at the invoice, right? And oftentimes the invoice is going to say, hey, when it was shipped make sure it was, delivered and then in service. So that's why time is running out on getting some assets placed in service.
Didn't know that one.
Yeah.
Okay.
So keep that in mind. Now, when I talk to, we're going to talk a little bit about sole proprietorships, which is, when it's like a doing business as or a single member LLC, and you're going to file this Schedule C. So most of your folks will know what a Schedule C is, but a Schedule C is just the tax return that you're filing on your individual tax return. I'll also bring up S corps as well, but I want you to people should know what type of entity they are, right? Because one of the things you want to sort of think about this time of year is, well, geez, I'm a sole proprietor. I'm a single member LLC. Does it make sense in the subsequent year, meaning in 2025? Does it make sense that I become an S corp? So it's something to think about. Now, I'm going to give you some rules of thumb, which is, you want to sit down with your tax professional and go through the actual numbers. But generally speaking, an S corp might be a better fit if you have a lot of income, because you might mitigate some, what you're paying in self-employment tax or payroll tax. So you have to be careful there because you have to pay yourself a reasonable wage. So what I think about this, and you only have until March 15th of 2025, in this case, to make the election. So while you're doing your year-end tax planning, you want to consider, am I, as I go into the future year, 24 into 25, and I'm a single member LLC, does it make sense for me to become an S corp? And it would be effective in the subsequent year, right? So you would become an S corp. You have a window of time up through March 15th of 25 to make an election for 25. So part of your tax planning is planning for 2025. Am I currently in the right entity? But let's get a lot of the nuance of 2024 done. Clean set of books, maximizing your deductions, meaning if you need some equipment, get it in now. Making sure when you're looking at like your own, if you have employees and you have yourself, I'm assuming you have a retirement plan in place. If it's just you, the retirement plans you have a plethora of choices to choose from. So oftentimes, if you have a pretty good year, you might want to think about having monies go into a retirement plan for yourself. If it's just you're a single member LLC, you don't have any employees, you can think about, hey, there's options out there to save for retirement and mitigate taxes all at the same time. And oftentimes you have some leverage in when those gets funded. So like a self-employed pension plan, like a SEP, you could have until the due date of the tax return to fund it, but you have to start thinking about it now because it's cash flow that's going to be going out the door in a subsequent year.
So Dave, in terms of the SEP, let's say, I know you said from a LLC, single member, that they can set up a SEP. Can the S corp do the same, or do they have to do another retirement plan or name of another retirement plan?
That's a really good question, Patrick. So if you change the entity type and you go to an S corp, it's going to be based on your W-2 wages, not your S corp net income. It's going to be on your wages. So those are all calculations you want to consider. Hey, so if you're a single member LLC, then it's a different calculation than if you're an S corp. But conceptually, you'll still get a deduction. So if you're an S corp and you're the only employee, then and you want to get the biggest bang for your buck, then people might go to like a solo 401k, which will allow you to put even more money into a plan. So on the retirement plans, those are things to start thinking about right now, because you could put one in place even now, like a SEP. And even though you make the contribution in 2025, it can apply towards 2024. A Uni-K would have had to be set up already. Those are or getting close. You're almost too late to set up a uni-K for 2024. But for 2024, you can start looking at maximizing your deductions and pulling in, as many of the deductions in, if your cash base is into 2024, if you're already going to need it. And I'm not saying going out and spend money you don't really need to spend. Like, don't spend money that you don't need to. But I'm just saying, if you need the supplies, or you need this piece of equipment, and you're going to order it anyhow, or you're going to use it anyhow, might as well get it into 2024 is kind of what I'm hitting at there.
So our business, the Jackman Group LLC, is single member. Sabrina's company is an S corp. So we have a SEP. Sabrina, do your company also have a 401k? Is that a SEP, or do you have something else?
It's the
A uni-K.
Uni-K?
Yeah,
Okay.
So that's really good. So let's talk about something about S corps that people really need to be aware of to really keep our friends at the IRS from bothering you.
That's always good.
That's always good. What you don't want to do is be there with a red flag saying, please come audit me. I'm bored. I'm looking for the life experience of being audited by the IRS. What you want to do is you want to be in compliance with the tax law, and you don't want to be, you don't want the friendly IRS agent showing up at your door. And one of the things they'll show up at your door for is not having reasonable wages. So you can't just have a big S corp and watch these TikTok videos, like the TikTok video defense. That will not work out well for you in the long run. What you want to do if you have an S corp is you have to pay yourself reasonable. The IRS doesn't really define it, but it is essentially, what would you pay another person to do that job in the same, if you were, step back a second and you had to hire someone to do the same job you're doing. So if you're making a big profit from an S corp, and you can't just say, I'm going to be on payroll for $10,000 per year and then make a big profit, and it's not going to pass the reasonable test. So that will get you in significant trouble with the IRS, because you're underpaying your payroll taxes, which in the end, you might want to pay some Social Security tax, because at some point down the road, when you collect Social Security, it's based on what you paid in. So keep that in mind in every entity that you are, that someday, when you get to be in your 60s, and 67 is the full retirement age for many folks, you might want to have Social Security credits paid in so you can actually have some Social Security as a retirement benefit when you do retire. And to that end is reasonable wages must be paid if you're an S corp. The other thing that I see a lot of people miss, it's a little nuance, but it's something I think people miss on the S corp side, is if you have health insurance and if you're an S corp, you have to be on payroll, thus reasonable wages, which I would recommend having a payroll service. Unless you're a payroll person, you can figure it out. But you want to make sure that you put your health insurance benefits, they go back on your W-2. So you got to make sure that if you have an S corp and you have health insurance, that health insurance being paid by the S corp, by the entity, that is an add back on your W-2. So just keep that in mind, because those are the things that once you start missing them, the IRS says, well, you might miss this. You might be missing other things. Why don't we just go take a look?
Yeah. What about life insurance and long-term care insurance?
So that would typically, like group term life, you get up to $50,000 before it shows up on your W-2. But, again, it depends on, if you're an S corp and C corp, similar. And then you get into different entities, like a C corp could deduct long-term care, but if the S corp, it would be typically put as a distribution. It's a non-deductible expense. It's really for the benefit of the employee, whoever it is. So it depends on the type of entity. Typically something like a long-term care, you'd want to pay that directly, not through your entities, because that way you can get a deduction on New York State if you're a New York State resident. So that's where it gets the nuance of what deductions are going where. It gets a little bit trickier. The other thing you might want to do if you're a business with inventory, and you may or may not have inventory, but you're going to have a really good inventory figure at the end of the year, right? So one of the items on your balance sheet is your inventory, how much inventory you have. So this is a good time of year to make sure that you have a good, accurate inventory count, and any obsolete inventory, you can get rid of and take it out of your inventory. If you reduce your inventory, then you increase your cost of goods sold, which increases your expense, which decreases your taxes. So those are things to sort of think about. Now, one of the things what you should have been doing, so we do have some time, but let's say you get to the point where like, oh boy, let's say you maximize all your deductions the best you can, then you can kind of at least figure out, hey, how much tax will I end up owing this year, right? And let's assume that you do owe some tax. You've got your taxes, you've maximized your deductions, you've accelerated your depreciation, you've taken consideration all of your retirement accounts that you're going to do, and you're short. You haven't paid in enough. Well, if you're a single member LLC, what you could do is you'd make a big tax, make your estimated tax payment as quickly as you can, to mitigate any interest or penalties that you would have, because you're going to owe them. You still have the January 15th estimated tax payment. You want to get that payment in as quickly as you can, because if you hadn't paid all along, there's going to be some, you will still have interest and maybe some penalties, but it'll at least reduce it. In other words, if you owe the IRS, it doesn't get better with time, is what I'm saying. So get that estimated tax payment in there. If you're an S corp, what you could do, let's say you're short $20K. Let's say you had a really good year and you have an S corp and I'm $20K short in tax. You can run a payroll at the end of the year. We still have time to have that $20K withheld, so it's all on your W-2. So when you do file your income taxes, you'll have that withholding paid in. The IRS treats the withholding a little bit different than they do estimated tax payments. It's a nuance between how the federal tax system treats withholding versus estimated tax payments. If you're an S corp and you're not signed up for this pass-through entity tax, which is called PTET, that's something to consider going forward into 2025. But if we're still in 2024, make sure you make your PTET, which is an estimated, it's a tax on the profit from the S corp that's paid to the state, like New York State. Then you get a deduction on the federal side, and you get a credit on the New York State side. So take that into consideration, and also take into consideration on the New York State side, if you're an S corp and your gross receipts are less than $1.5 million and you have payroll, New York State's going to give you a small business modification deduction of about 15%. So if you're an S corp and you're watching this, go back and look at your tax return. And if you met those criteria, less than 1.5 million in gross receipts, and you had a payroll, look to see if you do have that small business modification. It's a deduction of about 15% on the New York State side that I often see missed. Well, it could be, more money in your pocket if it's missed. And we have one more year of this QBI, the qualified business income deduction. So making sure, that you would get, depending on if you meet certain criteria, we'll make sure that's on your tax return. So if you look at last year's tax return, you want to look to see, did I get this deduction? I'm assuming if you're going to a CPA, you're getting the QBI deduction. It's like a 20% deduction of your net income. Most people will qualify for it. There are exceptions, of course. There wouldn't be the tax code if there weren't exceptions to it. And that small business modification are things that you want to make sure it was done correctly in the past, and it will be done correctly when you file your income tax return.
Now, Dave, you mentioned New York State. Is that deduction nationwide? Like Sabrina is in Jersey.
So no. So
our viewers are all over the country.
Yeah. So that small business modifications, New York State only. The QBI is federal, but every state might have their own little nuance. So New Jersey may have something similar to that. New York State does have it. So if you're a New York State S corp partnership, you might see that you should see that if you meet that criteria. But if you're outside of New York State, then that does not apply to you.
Okay, great. What else so we have what, 3 tips, Dave, that we are at now, or?
Yep.
Okay.
Besides accelerated appreciation, so that's when you take, you buy a piece of equipment, you can take it all at one time, or you can spread out over time. And even bonus depreciation means you can take, now that's going, it used to be 100%, and in last year, meaning 23, it was 80%. This year it's 60%. There are different forms of depreciation. That's about placing your asset. But most small businesses, you'll be able to write off most of the equipment all at one time. So think about that.
So if I bought myself a new camera for streaming,
right,
I can depreciate that. Is that part
correct?
of?
Or you can write it off. Now there's de minimis rules, like if it's less than $2,500, you can just expense it. But let's say it's $10,000, even $100,000, you could write it all off at one time. But keep in mind, then you wouldn't have that depreciation going forward. So you could take it all now, but then you wouldn't get it in the future. So those are things you may want to consider. So that's why, and let's go back to the camera example. If it's a $10,000 camera or thereabouts, you want to make sure that you have placed that in service before the end of the year. That's the gotcha with equipment.
Got it.
If it's de minimis, meaning less than $2,500, there's elections that you should be on your tax return for safe harbor elections. So that's why it's important to make sure you engage yourself as CPA who's keeping up on all these things and making the proper elections on your tax return, because you don't want to do these things and then the election's not made on your tax return, and all of a sudden you get audited and now you have a significant emotional event, and you want to try to minimize those when it comes to the IRS. You want to follow their rules, and same thing with the state that you happen to be in, and make sure you know the rules so you can follow the rules. And they are quite complicated at times.
Okay.
Dave, I have a question about the deduction thing. In terms of 2 things, if I needed to purchase a piece of software, that I guess would go under a deduction as well.
Correct. Yeah.
And also sign up for education classes, right?
Yeah. Yes.
All of those are deductible.
You got it. Yeah.
Awesome.
And software is now nowadays, back in the old days, you would buy software and you'd own it.
Yeah,
now it's like a software as a service, right? So, but yeah, software is presumed to be, if it's like a, software, it's going to be placed in service typically right when you turn it on, right? It's, whatever it is. And
yeah.
Sometimes you got to pay them up front. Correct.
So whatever that initial purchase, you'll be able to deduct it.
Correct. Right.
Within that tax year.
Right. And it gets a little bit nuancy, like, but most of the software these days are like, you're buying it for like a year, right? So like Microsoft, you can pay monthly, you can pay up front.
Right.
Same thing. And if you don't pay it the following year, they shut you down. So, correct. So software is typically
software and education, because there are a couple of classes that I think I want to pay in this year.
Right.
That way I can get the deduction.
Yes, exactly. So in my field, we got to take continuing professional education so we can keep on top of the tax law. And it's done online typically, and they charge your credit card, and you're going to take a class on the, whatever, you are for CPAs on tax, and you could deduct in the same year. And the same thing for you if you're taking classes. You take the class this year, typically it'll be deductible. It's deductible when you pay it. Even if you pay it on your credit card and you don't pay your credit card off until January, if you paid it on your credit card in December, it's deductible in that current year. And so in 24, it would be deductible, even though you don't pay your credit card off until say 25.
Right. Yeah. Cool. I like that.
Yes. This is also a time of year to maybe review your employee benefits to make sure that you're keeping up with all the rules. All New York State and the federal government love to have rules about making sure you're paying them the correct amount, right? Because minimum wage is changing, and you want to make sure that's correct going forward in 2025. But for 2024, if you give out employee bonuses, because none of us would be here unless we had a great team working with us.
Right.
This is a good time to give them a Christmas bonus and not be a Scrooge and get your tax deduction all at the same time. So if you have If you're going to give it a bonus, give it out, before the end of the year,
Okay, so the bonus needs to be taken before the 31st.
Correct. Yes.
Not before January 15th.
Correct. Yeah. So let's say you have employees and it's getting close to Christmas and you want to give them a bonus for Christmas, then this is the time of year to do it. It'll be in their final W-2. So the employees will get a bonus and you'll get a deduction.
Well, what about when you run payroll,
Mm-hmm.
you have up to the 15th of January to submit that last payroll tax?
That's okay. That's okay. As far as the federal tax deposits, correct. And some people are on 3 days tax deposits. And so as far as a tax deposit, even if the tax deposit for their payroll doesn't go in until January, you'll still get a deduction as if it was paid in 2024.
So I have this, let me make sure this is a clarifying question. If I want to do a bonus, I write the check for a bonus, but if I don't know what the deductions should be, I can run that piece in January.
Yeah. So when you run payroll, like you go through a payroll service, or even if you do it yourself on QuickBooks, you put in gross, say $15K, the payroll service will figure out all your payroll
taxes.
Yeah.
Okay,
and even if that federal tax deposit didn't get paid until January, you would still be as if you paid it in the prior year. Right? But most of these payroll services they'll suck the money right out of your account right when you run the payroll, because they're going to turn around and give the money to the IRS or New York or whatever state you're in.
Okay. Thank you.
Yeah.
Great information, Dave. Does that sort of payroll, does that also go for if you have no employees, but you have 1099 contractors?
Yeah. So if you have 1099 contractors, I'm going to give you two tips for one on that one.
Tips. Okay.
Tips
Let's go.
For 1099 contractors, make sure you have a W-9, which you collect all of their information. So you'll know the name of the contractor and the type of entity. Let's say it's an LLC or an individual, and you want to collect their federal ID number. You make sure you have the W-9 before you pay them. Typically, sometimes people don't want to give you the W-9 after you've paid them. Mm-hmm. But assuming you collect that information, yes, Patrick, you want to make sure that payment to the contractor gets paid before the end of the year. And then at the end of the year, meaning in January of 2025, the second tip is you got to make sure you issue a 1099 to the contractor, to your landlord, if your landlord is an LLC, to anybody you paid who's not a corporation. So they're typically LLCs or individuals. The business owner, must issue a 1099 to that contractor. And as a matter of fact, one of the very specific questions asked on your tax return is, were you supposed to issue a 1099, and did you issue a 1099? So you make sure you issue those 1099s for compliance purposes.
And those 1099s or W-2 will go out before, is it January 31st, right?
Correct, right. So the payroll service will issue the W-2s. You don't have to use a payroll service, but yes, your employees need to have their W-2s by January 31st, and your contractors need to have their 1099s out by January 31st as well.
Okay. All right.
So you want to make sure so that's a good point on the clean set of books. You want to go through all your contractors and make sure you have W-9s on file for them. Mm-hmm. Because when you get for your CPA, there's a shortage of us CPAs now. We're a dying breed here. There's not a lot of us in the game anymore. It'll be very helpful to you to have that. Like we go back to the first thing I talked about, the clean set of books, and then you can be able to say, yes, I've issued these 1099s, or you can have a third party do it, like the CPA could do it, or whoever else. But they nonetheless have to be done. So that's a good point.
So you said there's a dying breed of CPAs. So where are the CPAs going, and who's going to service all these new businesses that's coming on board?
So the CPAs, a lot of them are retiring. A lot of them are moving on to, maybe they'll pick up a job as a controller, because the tax game is, no pun intended, very taxing. It's a difficult game, right? It's a difficult game, and it can be, a bit, complicated and stressful. And, a lot of times CPAs are understaffed. So that's really what's happening. So the CPA may be there, but his staff may not be there. Hence, you can only take on so many client load, and you want to make sure you have margin, so you're able to spend a maximum amount of time you can with the client to keep them in compliance and not be in a situation where you're overloaded, in which case you'll be more prone to mistakes. And you don't want to be, so you want to be focusing on your niche, focusing on your clients, and have the bandwidth to handle that. And so a lot of CPAs have had to, downsize their practices because of the staffing issues. There's not a lot of people coming through the pipeline, even though there might be older CPAs. There's less younger CPAs coming in, helping get the work out the door.
Wow.
Just to confirm, Dave, if you're an S corp, I don't typically get a 1099. I just do.
Correct.
Usually.
So one of the questions on the W-9 is the person. So normally in this case, let's say Patrick would issue you a 1090, give you a W-9, and on there you check, I am a S corp, because Patrick wouldn't know.
So I should still give Patrick a W-9.
Correct. And on there, it'll ask you what type of entity you are. Because a lot of LLCs could be C corps or could be S corps, or could, in which case the corporations don't need to get the 1099s, but the partners or single members do.
So should we both give each other a W-9 then? Because Sabrina is a partner and vendor of ours.
Correct.
And I'm a partner and vendor of hers.
Yeah.
And she should be issuing you a correct. Each of you should give each other W-9s. And then each of you, I should say Sabrina to you, if you're a single member LLC, should be issuing you a 1099 at the end of the year. And then let's say she has a landlord and she's paying rent to the landlord, then she should be issuing a 1099 to that landlord. Right.
Interesting. Okay.
Yes. Yeah. It can get complicated pretty quickly. So yeah. And then we haven't got in, we could talk all about QBI and making sure, S corps, if you're paying rent to yourself, self-rental counts towards the QBI. Those are all little nuances. So these are things that, if you're, I'm assuming, my colleagues in the CPA world are very competent. They're very good, hardworking people and know all of these things. But you may want to end up with you want to find yourself a person who's credentialed, typically like an EA or a CPA who does tax. So you want to make sure. There's a lot of things that get missed on tax returns that, that I see where people are doing them themselves online, or, they're going out and getting software that they might be blissfully unaware that they're violating the tax law or leaving money on the table. And you don't want to be doing either. You want to be in compliance with the tax law, follow the rules so you can sleep at night and be a good, honest person. And also make sure you're not, spending more money on tax than you should, because the IRS isn't going to come back and say, you should have taken this, you should have done that. But they will come back. If you're violating the tax law, they will come back. And now you're going to owe the tax plus interest plus penalties. Yep. And right now, QBI is stayed, but I would still file your BOI report just to have it over with and done.
Yeah,
we did ours. Think about, right? It's not in your mind anymore, right? Because you don't have to follow it. It's just make sure you're following the rules and staying in compliance when it comes to those. The penalties on that are astronomical. Right now it's stayed, but we don't know what's going to happen in the future. So my advice would still get the darn thing filed and be done with it.
Get it done.
Right.
All right, Dave, we are way over. I want to thank you. I think I have one other question. And Sabrina, I'll throw it to you if you have another question for Dave so that we can wrap this episode up. Mine is, what's the difference between online, you hear about tax strategists, difference between a CPA, and is there such a thing as a tax strategist? And if there is, what is the difference between those two?
I think when I hear the word tax strategist, I think of orange jumpsuits and maybe the ball and chain, and someone who really wants, and I think that this is a person who's selling you maybe a tax dodge or something that's not quite legal or not right. And I think of CPA, I'm thinking a person who's actually credentialed, following the rules, knows the rules, and will actually produce an accurate tax return to the best of their knowledge. And when I see these things online, I just cringe, because as a CPA or an enrolled agent or any professional tax preparer, you can't just get, a percentage of their refund based on some tax strategy. That's not legal. That's outlawed. IRS clearly states that in their circulars, that this is not an illegal thing. You want yourself a good, solid CPA who understands the tax law, or an enrolled agent or a tax professional who's going to, have you follow the rules and pay the least amount of tax allowed by law. Not, so when I hear those things on the internet, I'm just thinking to myself, yeah, these are people who are going to get other people in trouble. And then when it hits the fan, they're going to be in the wind, and you're going to be facing the IRS, and they're going to be looking at you, the taxpayer, who's ultimately responsible for that tax return. When you sign that tax return, you're saying this is true and correct representation of what's going on. It's actually you who will be on the line, and that tax strategist will be in the wind. That's why you want to make sure you got yourself a good, solid tax person, whether it's a CPA or not.
Okay, great. Thank you, Dave. Sabrina?
No, I think this was great. And just as a company that we've had a tax firm, an accounting firm, do our taxes for quite a few years now, I have to say that if you can manage to have some sort of professional evaluation, overview, or as a service, go ahead and do it, because you just sleep better at night.
Right.
And that all the ducks are in a row the way they're supposed to be. So it's, there's, like you said, Dave, there's so many nuances, there's so many new things come up and whatever. So just it's nice when you can, if you're able to do that. But I'm sure there are services too, where if it's even you do your own books and at least have them review things when you're filing your returns.
Exactly. And exactly right. You want to make sure there's the things that, the things and things you don't know. And often it's the things you don't know that get you in trouble.
Right.
Have a good, solid relationship with your tax professional.
Absolutely.
Right? And be in contact with him or her throughout the year. And, to me, that's worth, a little bit more of a premium to make sure that you are doing the right thing. Like if it wasn't for the BOI, if your CPA didn't tell you about that, then who would? FinCEN's not calling you up and saying, hey, Sabrina, it's time to file your BOI report. But, you could have, you're exposed to a $591 per day penalty index for inflation. So I don't know what it'll be.
Right.
Right. I mean, these are things that will be extremely expensive if you're not in compliance. So hence be in compliance, know the rules, and make
totally.
sure you're doing what you're supposed to. A lot of people forget about issuing the 1099s. I'm glad that Patrick brought that up. It's something that you there's a question right on the darn tax return. Have you issued 1099s or will you? In other words, are you in compliance with that? You want to make sure, because the IRS is looking for things like that, and that's a whole nother set of penalties for not issuing the 1099. So it's a minefield out there, and you want someone to help you navigate that.
Yeah. Well, thank you so much, Dave. This was really great information. So thank you.
No worries, guys.
Good. Thank you, Dave. Someone in New York State, or do you just focus on Monroe County?
I do all of New York State,
Okay.
I mean, anywhere. I'm limited as to, I'll look at, each client individually to see if they're a good fit. I'm being selective in who I'm taking on and making sure I can have the staff just best service that person. I don't want to be taking on people that I can't service well. So every client needs to, make sure they're a good fit for me. They're going to follow the rules. They're going to do what they're supposed to. They're going to have a clean set of books. They're going to also make sure I have a staff person to be assigned to their account to make sure that they have the best possible outcome. I don't want to be stretched so thin where people aren't getting the best possible service they deserve.
Awesome. Do you have clients nationally too, Dave, or
Yeah,
just New York State?
All throughout the United States.
Also, okay, great. So go ahead, and if someone wants to get a hold of you, Dave, that's nationally throughout New York State, how do they?
But again, I'm very selective because you'd be surprised the scams. People try to have you open up files and they're all scamsters. So we'd have to talk. If they're, ideally I meet them in person, but I won't, I won't just open up any old email because I got to protect my client's PII. So
Sure.
But yes, I'm open to, if it's a good fit, we'll see. I want to make sure that it's a good fit for both of us. I don't want them thinking one thing and having expectations that can't be met. And I have, same thing for me on their end.
Okay. All right. So your email address, or you prefer your number?
Email is simply dyoung@youngandcompany.net.
Okay.
Yep.
And all that information will be in the show description.
Right.
So Dave, thank you so very much again. Happy holidays to you and your family. Sabrina, happy holidays. We will do our, is it our final show? Let's see here. We'll do our wrap-up show. Actually, yeah, next week is the final show of 2024.
Dang.
Wow. So we'll do our wrap-up show next week. So look out for that, where we'll have some more guests on. So thank you guys so very much. Enjoy your holidays, and Merry Christmas and Happy Holidays to everyone out there.
Yeah, happy holidays.